12 trillion rupees. Gone. Vanished in just 48 hours. If you're holding gold right now, what I'm about to show you is going to shock you because the gold market just experienced one of the most violent liquidations we've seen in years, and nobody in the mainstream media is talking about the real reason why this happened. I'm talking about massive vault withdrawals, COMEX registered gold dropping to levels that should terrify central banks, and a price collapse that wiped out the equivalent of India's entire annual budget in less than 2 trading days. Stay with me because by the end of this video, you'll understand exactly what's happening behind closed doors and why the next 2 weeks could determine whether gold crashes to $1,800 or explodes past $2,300. Let's get into it. So what exactly happened in the last 48 hours? On Monday morning, gold was trading comfortably around $2,130 per ounce. The market sentiment was bullish. Physical premiums in India were sitting at around $12 to $15 above spot price, which is normal. Shanghai Gold Exchange was showing healthy demand from Chinese buyers. Everything looked stable. Then Tuesday happened. Within 6 hours of New York markets opening, gold dropped like a stone, falling nearly $90 in a single session. That's a 4% crash in one day. When you convert that to the global gold market value, we're talking about approximately 12 trillion rupees that just evaporated from market capitalization. Show chart, gold daily candles with volume spike. But here's what nobody is telling you. This wasn't just a normal correction. This was a coordinated liquidation event, and the fingerprints are all over the COMEX data. Let me explain what I found when I dug into the numbers, because this is where it gets really interesting. The registered gold in COMEX vaults, which is gold that's actually available for delivery, dropped by 62,000 ounces in just 1 week. That's nearly 2 metric tons of physical gold that either got delivered or reclassified as eligible, meaning it's no longer available for immediate delivery. Now, why does this matter? Because when registered inventory drops while open interest remains high, it creates a powder keg situation where too many paper contracts are chasing too little physical metal. Let's talk about the mechanics of what's actually happening here, because this is crucial to understanding where gold is headed next. The COMEX gold futures market operates on a fractional reserve system, just like banks. For every 100 ounces of paper gold traded, there might only be 5 to 10 ounces of actual physical gold backing those contracts. This works fine when everyone's playing the paper game, but the moment people start demanding physical delivery, the whole system gets exposed, and that's exactly what we're seeing right now. Over the last 3 months, we've seen a steady increase in delivery demands, particularly from Asian buyers and sovereign wealth funds who don't trust the dollar anymore. Show chart, COMEX registered gold inventory chart 6-month view. Now here's where it gets even more interesting. The crash on Tuesday coincided with a massive spike in trading volume during the London afternoon session right before New York opened. We're talking about volume that was 300% above the 20-day average. Someone dumped a huge amount of gold futures contracts into the market in a very short time window. This is classic spoofing behavior. You dump massive sell orders to trigger stop losses and create a cascade effect, then you buy back at lower prices. The Commodity Futures Trading Commission has fined banks over $40 million for doing exactly this kind of manipulation in precious metals markets. Morgan HSBC, Deutsche Bank, they've all been caught doing it. So when I see this kind of price action with this kind of volume profile, my alarm bells go off immediately. But let's dig deeper into the Indian market specifically, because this is where things get really wild. India is the world's second largest gold consumer after China, and the Indian rupee gold price is directly impacted by both the dollar gold price and the rupee-dollar exchange rate. When gold crashed $90, that translated to roughly 7,300 rupees per 10 grams in India. But here's the kicker. Physical gold premiums in India actually went UP during this crash. Dealers in Mumbai and Delhi were reporting premiums of $18 to $22 over spot price, compared to $12 to $15 the week before. What does that tell you? It tells you that physical demand is strong. Indian buyers saw this dip as a buying opportunity, not a reason to panic. This disconnect between paper price and physical demand is exactly what happens before major supply squeezes. 8:15. Let me show you what's happening in the Shanghai Gold Exchange, because this is absolutely critical to understanding the global picture. The SGE operates differently than COMEX. Every contract on the Shanghai Exchange must be backed by physical gold. You cannot trade unbacked paper gold in Shanghai. And right now, the SGE premium, which is the difference between Shanghai gold price and London spot price, is sitting at $15 to $18. Historically, when this premium goes above $10, it signals strong physical demand in Asia that's pulling gold away from Western vaults. During the last major gold bull run in 2011, SGE premiums hit $30 before gold peaked at $1,900. We're not there yet, but we're moving in that direction. Chinese buyers are accumulating, and they're doing it quietly while Western investors are panicking over a 4% dip. Now let's talk about what the central banks are doing, because this is perhaps the most bullish signal for gold that nobody's paying attention to. According to the World Gold Council data, central banks purchased 845 tons of gold in the first 9 months of last year. That's the highest level of central bank buying in over 50 years. And who's buying? China, Russia, India, Turkey, Poland. These aren't random countries. These are nations that are actively trying to reduce their dependence on the US dollar. When central banks are buying this aggressively while the price is dropping, that tells you everything you need about where smart money thinks gold is headed. Central banks don't chase momentum, they accumulate on weakness. And right now, they're accumulating like there's no tomorrow. Show chart, central bank gold purchases bar chart. Let me explain something about market structure that most people don't understand. When you see a violent sell-off like we just witnessed, you need to ask yourself who was selling and who was buying. The selling came from leveraged traders who got margin calls, from algorithmic trading systems that triggered stop losses, and from weak hands who panic sold. The buying came from physical dealers, from sovereign wealth funds, from central banks, and from informed investors who understand that nothing fundamental has changed about gold's long-term value proposition. The U.S. national debt is still $34 trillion. Real interest rates are still negative when you account for actual inflation. Geopolitical tensions are still escalating. The dollar's reserve currency status is still being challenged. All the reasons to own gold are still intact. The only thing that changed is the paper price got smashed by traders playing games in the futures market. All right, let's get into the technical analysis, because this is where we can identify specific levels and make informed decisions about what's coming next. On the daily chart, gold has now broken below the $2,100 support level that held for the last 6 weeks. This is significant because 2,100 was a key psychological level and also the 50-day moving average. When price breaks below a major support, that support often becomes resistance on the way back up. So if gold bounces from here, we should expect heavy selling pressure around the 2,100 level. Show chart, gold daily with moving averages and support levels. The next major support level sits at $20,040 to $20,060. This zone represents the 38.2% Fibonacci retracement of the entire move from the October lows around 1930 up to the recent highs around 2150. Fibonacci levels matter because institutions use them, and when institutions use them, they become self-fulfilling prophecies. If we break below 20,040 with conviction, meaning we get a daily close below that level with strong volume, then we could see a deeper correction toward 1980 or even 1940. But here's what's important to understand. Even if we do get that deeper correction, it doesn't change the bullish long-term structure. It just means we get a better buying opportunity. On the 4-hour time frame, we're seeing some interesting price action right now. After the initial crash, gold bounced about $30 off the lows, which is typical dead cat bounce behavior. But what I'm watching closely is whether we can hold above 20,070 on the 4-hour close. If we can, that suggests buyers are stepping in, and we might have found a short-term bottom. The RSI on the 4-hour is oversold at 28, which historically has been a good contrarian buy signal for gold. The last 3 times the 4-hour RSI dropped below 30, gold bounced within 48 hours. Now that doesn't mean it will happen again, but probabilities favor at least a short-term relief rally. Show chart, gold 4-hour with RSI indicator. Volume profile analysis is also giving us some important clues. The highest volume node over the last 3 months sits at 2110 to 2120. This means that's where most traders have established their positions, and it's likely to act as a magnet for price. If we do get a bounce from current levels, I expect price to gravitate back toward that zone before deciding on the next major move. If we reclaim 2120 and hold it for a few days, then the correction is likely over and we're headed back toward 2150 and potentially new highs. But if we get rejected at 2100 and roll over, then we're probably going to test the lower support zones I mentioned earlier. So where do I think gold is headed from here? Let me give you my honest assessment based on everything we've analyzed. In the short term, over the next 2 to 3 weeks, I think we're going to see continued volatility. The technical damage has been done, and it's going to take time for confidence to rebuild. I wouldn't be surprised to see gold chop around in the 20,040 to 2100 range as bulls and bears battle it out. The key catalyst to watch is the Federal Reserve's next policy meeting and any comments about interest rate direction. If the Fed signals that rates are staying higher for longer, that could put additional pressure on gold. But if they hint at potential rate cuts later this year, gold could explode higher because lower rates reduce the opportunity cost of holding non-yielding assets like gold. Medium term, looking at the next 3 to 6 months, I remain very bullish on gold. The fundamental drivers are simply too strong. We have an election year in the United States, which always brings uncertainty. We have ongoing conflicts in multiple regions that could escalate at any moment. We have a banking system that's still fragile despite what the media tells you. Remember, it was only last year that we saw regional bank failures that required emergency Fed intervention. Nothing has been fixed. The problems have just been papered over with more debt and more money printing. And when the next crisis hits, and it will hit, gold is going to be the asset everyone wishes they had bought more of. My target for gold by the end of this year is $2,300 to $2,400 per ounce, assuming we don't get a major black swan event. If we do get a crisis, all bets are off and gold could go much higher much faster. Now, if you're watching this and thinking about whether you should buy gold right now, let me give you my perspective. Dollar cost averaging is your friend in volatile markets like this. Don't try to time the perfect bottom. Nobody can do that consistently. Instead, if you believe in the long-term case for gold, start building a position gradually. Buy some now, buy more if it dips another $50, buy more if it dips another $100. This way you average out your entry price and you don't get caught trying to be too clever. Physical gold is always preferable to paper gold if you can manage the storage and security. But if you're investing through ETFs or sovereign gold bonds, make sure you understand exactly what you're buying and whether it's actually backed by physical metal. Look, the bottom line is this. 12 trillion rupees disappeared from the gold market in 48 hours, and it's created both fear and opportunity. Fear for those who don't understand what's really happening, and opportunity for those who do. The smart money is accumulating. Central banks are buying. Physical demand is strong. Yes, the paper price got hammered, but nothing fundamental has changed about why you should own gold as part of a diversified portfolio. We're living in a world of unprecedented monetary experimentation, record debt levels, and increasing geopolitical instability. Gold has been money for 5,000 years, and it's going to outlast every fiat currency that's ever been printed. This sell-off is noise. The trend is still your friend, and the trend over the last 2 years has been definitively up. So what do you think will happen next? Are we headed back to all-time highs, or is this the start of a deeper correction? Drop your price predictions in the comments below. I want to hear what you're thinking. And if you found this analysis valuable, if it helped you understand what's really going on behind the headlines, do me a favor and smash that like button. It helps the algorithm show this video to more people who need to see this information. Subscribe to the channel and hit that notification bell because these markets move fast and you need to stay informed. The next major move in gold could happen at any moment, and I'll be here breaking it down for you when it does. Until next time, stay sharp, stay informed, and remember, in a world of paper promises, gold is the ultimate truth. I'll see you in the next one.